All right, a lot of you want to know if it's not going into stocks, with the Dow down about 543 points. A big chunk of that, of course, Apple and the fall of fear after the weak China report. Where is it going? Well, right now, a lot of it is going to the relative safety of bonds. By comparison, you might not get a lot of bang for your buck at around 2.5% for a 10-year note, but it certainly beats losing your shirt. And in harassing times like these, that's okay. Stanford School of Business lecturer Dave Dodson on what all of this is saying. Very good to have you, Dave. And is it your view that bonds or the markets for the time being are telling us are a safer bet than stocks? I know that's obvious today, but that might hold out, that people will seek out the relative security of fixed income investments rather than roll the dice on stocks.
Oh, sure. We've had this very interesting balancing where, with interest rates basically at an all-time low for 9 years, we've had this sort of Fed sugar high for 9 years. There's been nothing in bonds. So, of course, there's been this migration to the equity markets. As interest rates come up, we're going to see some migration back from the equity markets to bonds, which is healthy for the economy. We have to remember that what's happening here is not the Fed's cranking up interest rates unnaturally, but we are unwinding 9 years of Fed policy that was very permissive, both in terms of interest rates and in terms of liquidity for the market. And that's what we're seeing. And if we stop focusing on our obsession with what happened yesterday in the stock market or last week's job report, and instead start thinking about the long-term health of the economy, we'd say this is perfectly fine.
That's well put, but it belies the fact that we have all these fancy graphics and music every time the market tanks. So if you'll just endure that. But, Professor, one thing I wonder about is how the Fed is in this proverbial box here. I mean, there might not be an inflationary reason to keep raising rates, much of it to undo what has been done over the last, roughly decade, where we had near 0% rates, and that's the rationale behind whatever hiking we would see, that there's very little inflation out there. I don't know if you concur with that and whether that's a risky rationale, but what do you think?
Well, I think the issue is I don't think the Fed thinks they're in a box. I think the Fed thinks that it's time to, as I said, unwind this 9-year sugar high. Now, normally the Fed rates are between sort of 3 and 6%, and they need to return back up there, and we need to bring about $1 trillion of liquidity back out of the market. And one of the reasons why we need to do that is if the economy reaches a point where we do have some trouble, then the Fed's got some levers to pull. Right now, the Fed has no levers to pull. Now, look, if we're not willing to unwind this when we've had 5 straight years of GDP growth, when unemployment is at an all-time low, when, frankly, the stock market over the last few years have done quite well, then when are we supposed to do it?
So couldn't you unwind it, Professor, if you just, sell back a lot of those notes and securities rather than constantly raising rates and maybe encouraging a slowdown?
Yeah, well, there's certainly been some criticism that maybe they don't need to pull on both levers at the same time, both raising interest rates and pulling liquidity out of the market. But look, we have a massive amount of liquidity in the market right now. I don't think you'll find very many CEOs who will say they're having problems because they can't get debt through the banks or that they don't have enough cash on the balance sheet. So what the Fed has done is the Fed has said we're going to bring about $50 billion worth of liquidity out of the market month after month after month in a nice, predictable way. And by the way, we talk about how magical liquidity is and how magical low interest rates are. But while we've been doing this, corporate debt has reached $6 trillion. Now, to put that in perspective, that's 45% of GDP. Is that a big number? Unprecedented. We have never had that before. And meanwhile, our national debt, and we need to start focusing on some of these long-term indicators, our national debt of $22 trillion has now reached the point where interest on the national debt exceeds our entire military budget. And the worst part about this is we have no plan to get out of there. And that's what I think our policymakers should be worried about, not what the stock market did yesterday.
No, I think you're right about that. I will say this as well, and on this show we've gone after Republicans and Democrats for looking the other way. They're arguing, if you think about it, Professor, about $5 billion for a wall, where we're looking at, for the next few years, $1 trillion plus deficits added to the $22 trillion in debt that we have now, leaving out what's happening with states, leaving out what's happening with corporations, leaving out mid-tier companies that are taking on debt at a level that it's become virtual junk for them. You got to worry that a prohibitive uptick in rates is going to put the kibosh on all that.
Absolutely. You shouldn't be worried. You should be petrified about it. I mean, you think about it. Your network reported that the $5 billion is going to buy about 215 miles of steel fencing on a 1,900-mile border. It is pathetic that the Democrats and the Republicans have closed down the government, furloughed 800,000 workers over 215 miles of fencing. And by the way, this whole talk about a DACA for 200 miles of fencing deal is probably the worst outcome we could possibly have, because it does nothing to address our long-term issue of a southern border. You know, taking care of DACA does nothing for the other 9 million people that are here, and 200 miles of fencing doesn't do anything to address the porousness of our border or the incentives for people to come over here. But it is a wonderful excuse for our senators and congressmen and our president to ignore the mundane part of policy and put into a long-term solution for our borders. And that's what we need. And that, by the way, would produce market stability.
Yeah, no, you're right. But both sides have failed at that. I'm wondering, too, just your collective macro thoughts on what Apple is telling us, what Ford is telling us, what a lot of these technology concerns that are pegged to Apple, a lot of its suppliers and chip stocks, because of what's going on in China. Do we have to worry about that? This is something that Kevin Hassett has said today is going to, hit a lot of companies' earnings in this period, and we're not going to like it.
Yeah, I think that the Fed raising the interest rate a quarter point, which isn't that much actually, a couple of weeks ago distracted us from what's really happening, which is that we've got some very uncertain issues with our trading partners. And part of it is that I've got no problem with renegotiating trade agreements. I think we should be doing that from time to time. And you can do that from a standpoint of firmness. But you don't start by poking your trading partner in the eye and then expect to come up with an agreement where you're going to get two signatures on the bottom, on the end of the page. So I think one thing is that the markets are worried about our relationship with our trading partners. Another thing that's happening is that sometimes we forget what's happening in Europe. I mean, Europe has had nearly a decade of zero GDP growth, and now it's negative GDP growth in places like Germany and Italy. So we've got unstable trading. Not only do we have unstable trading agreements, but we've got unstable economies in Europe, and we need to depend on it. Those are the kind of things that are troubling the short-term markets. The long-term outlook, as I said, should be more focused on where are we going to find the $12.5 trillion to cover our Social Security shortfall. How come the top 1% went from owning 25% of the nation's wealth to 40% of the nation's wealth while we've gutted out our middle class? These are the long-term policy issues that I wish our 535 congressmen would be focused on, and our president, not what the stock market did yesterday.
Well put. Professor, I would have loved to have been in your class. You would have failed me, but I would have loved to have been in your class. Thank you very, very much. Happy New Year.
All right.
All right, Dave
Good to talk to
Dodson.
you.
Very good, huh?